Imagine you work for a typical landscaping business. You know that trimming 2 of your customers' lawns in one morning will probably make more profit for the business than trimming just one. But how much more? Is it worth the rush? What if the second lawn is bigger or has more bushes to trim? If it takes longer, should you charge the customer more? How much more? And who should answer these questions anyway? Should it be you, the CEO, an accountant, or all of the above? In a typical business, the responsibility for those financial decisions, it's not shared by everyone. But in a cooperative, things are different. Whether it's a grocery store owned by its customers, or a collection of farmers marketing their products together, or a worker-owned co-op like a landscaping business, the cooperative members steward the business's finances together. Co-op members have a lot of power to make the business work for them. But with that power comes shared risks, shared rewards, and shared responsibilities. That means active members in a co-op will read financial documents at one point or another. But most of us don't have formal training for that. And that makes us anxious. There's a fear of losing money. And there might be an even greater fear of the unknown. Let's break down some of those unknowns together and see if we feel a little more empowered as co-op members, board members, and co-op organizers. This video is presented by Cooperation Works, a national network of cooperative professionals. This is Alex Stone, the Executive Director of Cooperation Works, and I'm Stephen Shelto, a co-op coach based in South Carolina. By the end of this video, we hope to teach you how to use important financial terms, how to read the 3 most commonly used financial statements, how to weigh the risks, rewards, and responsibilities of being a decision maker. To show you what it's like to get advice from a financial professional, we asked Tamar Yisrael, an accountant, financial consultant, and member of the Resolve Financial Cooperative, to work on an example of a cooperative that might need her advice. Let's get started.
Starting to learn about financials, financial literacy, financial statements can be really overwhelming, but most people can really relate to a good story. So we're actually going to dive into this topic through the lens of a story about a startup co-op of landscapers.
Meet the Planners. The Planners are a cooperative of landscapers who came together a couple years ago to start their own landscaping business. They know their trade well, but they're still new to things like finances and lending. They started small, pooling together $5,000 from each member to get started. But they've got big dreams to someday expand and become the highest quality landscaping business in their city. But the Planners have a problem. Specifically, they need trucks. They now have 20 worker owners, but the business itself only has 1 truck on its books. And the members are tired of sharing their personal vehicles to get to job sites. Owning more trucks will help them reach more customers each day. So they're gonna need to get an auto loan from a lender like a credit union. But before that can happen, they have some questions to answer.
They need to know a few things. One, they need to understand and review their assets. They want to understand their cash flows, and definitely want to determine if they want to increase profits versus creating more jobs or both. Do they want to acquire any debt? How will this impact their profitability? How will this impact the individual members?
When you hear the phrase pro forma, you're not just hearing a financial professional show off their Latin skills. Pro forma means formal or conforming to a common way of doing things. When all businesses use similar documents, it makes it easier for lenders and accountants to do their jobs. Financial statements are tools. Each one solves a few specific problems. Today we're going to talk about the 3 most commonly used financial statements. The profit and loss statement, a tool that tells us how the business has been performing overall. The balance sheet, a tool that tells us what the business currently owns. And a cash flow statement, a tool that tells us about the momentum of the business.
The first financial statement that we'll talk about is a profit and loss statement, sometimes referred to as an income statement.
Here's the Planners' profit and loss. Notice that it has 2 sections, revenue and expenses. There's a simple formula behind the profit and loss.
Revenue minus expenses equals net profit and loss. For a period, sometimes a month or a year, you'll have a collection of all the revenue, all the expenses, and the revenue minus expenses equal whether or not you've made a profit or a loss. This is what we call the net profit or loss. Revenue can be sales, income, or however you label it, but revenue is any money that's earned by the business. An expense or an expenditure is any cost incurred by the business. Looking at the planters financial statements or their income statement from last year, they had a small profit, not much to split between 20 co op members. So, one of the things that they want to be able to do is either determine if they want these profits to be distributed out to their members this year or use that to invest back in their cooperative.
So let's review. The profit and loss is a good tool for the planters to start with because it tells them how the business is performing over a specific time period. The P&L should include the start and end date of the period tracked. And if the planters have barely been able to make rent on their garage or their office space in the last year, they're not in a great position to buy a bunch of trucks, right? So if the planters are making a profit, they can buy a whole fleet of vehicles, right? Well, if you were their advisor, would you tell them to go ahead? No, probably not. It might not be enough money to pay off an auto loan, so we still don't have enough information. We're going to dive deeper using a couple more financial tools in a second, but at this point, you're starting to see how complicated some of these decisions can get.
People tend to have a general fear of finances in the beginning. There's the stigma that monitoring your finances as a business is really directly related to compliance only, dealing with the IRS and other compliance agencies. It's about you managing and running your business so that you're successful in what you do. And so I think approaching it from an understanding around how what you do impacts the numbers is a sticky point, but also a point of revelation for many co-op members.
While members of a cooperative are encouraged to participate and engage in democratic decision making, the legal responsibility for ethically and responsibly stewarding the co-op finances usually falls on the co-op's board of directors. If a co-op member is also on the board, then it's like wearing different hats. They need to know when they're wearing their member hat, when they're taking that off and wearing their board hat, and maybe also when they're taking both those off and wearing just their community member hat, if it's a decision that might impact the whole community. If you're on a board, your responsibilities are called fiduciary duties. In many worker cooperatives, all members might also be on the board.
These duties include the duty of care, and the duty of care looks at having and ensuring a standard of reasonable care for the business. It also means ensuring that there's prudent use of all of the cooperative's assets, and you don't want anyone going off making irrational decisions around how they use the cooperative's assets. There's also a duty of loyalty, and what this does is ensures that the activities and the transactions are really aligned with why we exist as a cooperative, our mission and our purpose. That also ensures that conflicts of interest are recognized and lifted out and shared and disclosed to all members. It also looks at decisions and that they are in the best interest of the cooperative. And the third and final duty, fiduciary duty, is the duty of obedience, which really ensures that the cooperative is in alignment and obeys all laws and regulations, that the cooperative is in alignment with its own bylaws. That's really important, as well as being adhering to its mission and purpose.
So, if we're looking at this question of whether or not they should buy a fleet of vehicles, let's say they're a green and eco landscaping cooperative, would they then also consider the difference between buying, say, a fleet of gas powered vehicles versus electric ones and be able to weigh those a little differently because the electric ones might be more aligned with their mission?
Absolutely. Yes, because duty of loyalty aligns what their financial responsibility is to their mission. Their mission is green. Eco-friendly vehicles should be at the center of what they're doing, and ways to save the environment should be at the center of how they're making their purchases and operating their business. So, yes, that is a perfect example of maintaining that duty of loyalty.
Balancing the needs of the co op with the needs of individual members can also get tricky. For example, the planters can't grow the co op without purchasing new trucks, but their workers may also need a pay raise to make ends meet that year. Which one will benefit the members more? Investing in the future or investing in the present? We need a few financial tools to help us answer this question. The next financial statement the planners are going to use is a balance sheet. A balance sheet looks something like this and essentially tells us what the business owns. If the P&L is like a recording over a period of time, the balance sheet is like a snapshot of one point in time. It has an as of date indicating when the report was created.
Now, the balance sheet is reporting on all of the assets, the liabilities, and the equity. It essentially tells a story of the lifetime of the cooperative, and it abides by an equation as well. Assets equal liabilities plus equity.
This formula is important to consider for a moment. Just like how a scale is only balanced if both sides are equal, the assets must always have the same value as the other side of the equal sign. In other words, if the equity or liabilities change, the assets change by the exact same amount. Let's get back to the planter's story to show how this works in practice.
And so, looking at this balance sheet, they have their current assets, which consist of their bank accounts, their saving accounts, any receivables that they have from invoices where they bill to customers, as well as inventory that they own, like plants, materials, and supplies for them to do their work. Other assets that they may own are fixed assets. These are more long term assets, things like their trailer and other equipment and tools. Going down into the balance sheet, we then line up with their liabilities. So they have some current liabilities, which are payables, bills that they have due. They even have a credit card. So this is also considered a liability. They haven't yet acquired a loan, but in their decision making around purchasing additional vehicles, this is something that they want to consider whether or not they want to do a bank loan. And again, a bank loan would go into the total liabilities. And then naturally, the next piece, as we mentioned earlier in the balance sheet, is the equity. And the equity is the net worth or the risk capital that the cooperative and its member owners have in its ownership interest.
So, could you walk us through what might happen to the liabilities and the assets if, say, the co op takes out a loan to purchase one more vehicle? What would that do to the assets and liabilities, and how would that equation still balance out?
In the case of they actually acquire three vehicles at a loan or value of $75,000, these three vehicles are an asset that is adding to the asset lineup, as you can see on the balance sheet, at the value of $75,000. And then they'll need to get a bank loan for the value of the vehicles, which is $75,000. And looking at the balance sheet, it's still in balance because what increases are the total assets, as we can see here, raising that up that additional $75,000, as well as their liabilities. Most of the time, I find that people don't actually have a balance sheet and they're not properly tracking their assets and not even seeing and realizing the value that they've invested in their cooperative. So first common misconception is that I don't need one. Well, you do, especially if you're going to a bank and speaking to a lender. This is how they determine how leveraged you are. And leverage basically means how much debt you have versus actual equity in the cooperative.
We also have to think about depreciation. A brand new truck loses value as soon as it's purchased and every year after that. On a balance sheet, we're going to see the asset value of the truck go down. We will also see the liabilities go down as the auto loan is paid off. And in the equity field, we'll see any difference between the amount still owed on the loan and the truck's value if it were to be sold. The word equity is usually confusing for people learning about business finances for the first time. Equity always refers to the amount owned by someone or some entity, the amount they have a claim to. But confusingly, we also use the word equity in slightly different ways. For example, when members first join the cooperative, their member economic contribution, Principle 3, becomes their equity stake in the business. This initial buy-in comes with 1 vote per member in the important decisions in the co-op, like voting on the board members. Depending on the type of co-op, the buy-in equity might be as little as $10 or as much as $30,000. You might hear this called voting stock. As the co-op gets started, it might need to raise money for a big purchase. It has 2 options, taking on debt or asking for equity investments. Debt, like a loan, is a lower risk for the lender, which means that the co-op pays back the loan with a low amount of interest. But selling equity in the co-op, on the other hand, is like a bet on future profits. It's a bigger risk for investors because their returns are going to be based on whether the business actually makes a profit. So they usually expect a higher reward for the risk they're taking. A co-op can limit equity investment to just its members, or sell non-voting shares to outside investors. If the business makes a lot of money and doesn't spend it all on wages and other costs, the extra amount becomes equity. In a co-op, the equity gets shared between members based on how much they contribute to the co-op. And any outside investors may also be contractually owed a certain percentage as well. One big advantage worker co-ops have over conventionally owned businesses is that member equity is taxed differently than wages. This is way too complicated for today's video, but just know that co-op advisors can help a worker co-op make the most of their hard work. When members leave the co-op, they get their initial equity stake and any extra equity they put into the co-op, and any equity earned as the co-op shared its profits by putting it aside in their member account. If it's a large sum, the co-op will probably pay them back over time rather than destabilize the co-op by paying it out all at once. What happens if the co-op goes out of business, though? This is one risk that you accept when you make any kind of equity investment. Anything that can go wrong in a business can go wrong in a co-op. A co-op member's equity is paid back to them when the co-op dissolves, but only if there's enough cash to pay back the other loans and equity promises that it's made first. This is yet another reason all co-op members should learn to read financial statements and understand the health of their business so they can keep it going. I mean, there is a non-zero chance that they might lose a big investment of their own cash. An important number you might see over and over again is the business's debt to equity ratio. This helps lenders measure how risky their lending to a business might be.
The debt to equity ratio basically is a ratio that measures the financial leverage through comparing liabilities to equity, the owner's investment. So for this cooperative, the debt to equity ratio prior to the bank loan was they had 2 cents of debt to every dollar of equity that the members had invested in the cooperative. So very low ratio here. In this new scenario, they will obtain a loan which will equate to $1.05 per dollar investment into the equity. So member equity and debt are almost the same in this scenario. In the first scenario, before they purchased the vehicles, they had 2 cents of debt to every $1 that the member had invested. After they purchase, or if they purchase the vehicles, it would be $1.05 of debt to every dollar of equity that the member invested.
Now that we've covered assets, liabilities, and equity in detail, let's practice sorting a few examples of those things. As the budget item appears on the screen, take a moment to consider which bucket it should fall into: assets, liabilities, or equity. Pause the video and categorize each term. Then we'll show you the answers. Are the planters making a profit? Yes. We've used the profit and loss statement to answer that question. Would a lender be reassured that they have few liabilities that would get in the way of them paying back a new loan? Yes. We've used the balance sheet to answer that question.
We do want to look at like seasonality and how the revenues come in. And naturally, as a landscaping cooperative, the summer season is when they need to have more capacity. So we want to see if this purchase or this acquisition can happen before the summer season.
So the lender does not have all the information they need. If the co-op doesn't have the exact same expenses and revenues every single month, if it's paying for a big expense like a auto loan each month, there could be a month or even a series of months where it runs out of cash. We need a tool to help us predict if that might happen.
The last and final of the financial statements that we'll address here today is the cash flow statement. And it really summarizes the movement of cash and cash equivalents that go in and out of the cooperative.
One way of describing the cash flow statement is that it's a tool for showing us the momentum of a business. Is the business's seasonal momentum going to make it run out of cash? And if so, what could change it to get back on course?
And looking at the planter's statement of cash flow, they built out a projection. They can anticipate increasing revenue for larger projects by 30% and potentially increasing the revenue for smaller projects by 15%. So they'll need to be watching their cash flows over a longer period of time just to make sure that these revenue projections are accurate. They also are making the assumption that they will make the purchase at the beginning of their busy season, which is spring. But once they do make that purchase, they will notice an increase of their revenue potential, but also an increase in their labor. We're going to actually project out their cash flows up into the following year just to see and get a good analysis of when will this purchase actually break even. We also notice that there is a negative net cash monthly in the first month of their purchase because of the down payment on the loan, as well as them needing to pay additional expenses of having the loan. And as they went into the following high season in 2024, after a low season in the winter of 2023, they began to realize an actual profit from their production. So the strategic timing of the purchase was really important for them to increase their capacity to service more customers, actually keep the members working at a season that was really important for them to work, and prepare them for a low season in the winter. Probably not advisable for them to operate at such low capital, so less little cash on hand, because of the seasonal nature of their business. One, they could either find that they run out of actual cash to pay their bills. They could either make a decision to close the business, seek additional funding, or not pay themselves to generate the revenue. So there are several things that they will need to look at in ensuring that their business is sustainable.
I know one thing that can happen with some businesses is that they tend to pay their employees on a biweekly basis, which is pretty standard for a lot of businesses. But oftentimes, if you have clients, you're invoicing them, and those might not be due for 30, 60, or even 90 days. So if you're paying for people for work that you're not getting paid for another month or two, that can really throw a wrench in your plans if you don't have adequate cash on hand, right?
In reviewing your statement of cash on hand, you want to know that having more days cash on hand is always better than having fewer days cash on hand.
It turns out if the planters had purchased the vehicles during the wrong month, they could have run out of cash and not been able to pay their members. Now that we've seen all three financial statements in action, let's think about how they work together. How would you describe them to a new co-op member who had never seen business documents before? Here are some other useful examples. One useful metaphor is a stool. We know a stool can't stand on one leg or even two legs. It needs three or more. In a way, a co-op's balance sheet, cash flow, and profit and loss statement, they form the three legs of a stable stool. The balance sheet tells us what's owned, the P&L tells us about performance, and the cash flow tells us about momentum. You could also say the balance sheet is like a snapshot. It captures a single moment in time, where all the assets, liabilities, and equities are in that one moment. A P&L is more like a video recording. It's like rewinding to see what happened over a period of time. You might say that a cash flow statement is like a map, showing you all the upcoming obstacles for the business. But it's just a map, and the actual reality of traveling might be a little different. Another metaphor is to think of ourselves as cooks, and the financial statements like recipes. If we're all making pancakes, and we decide to double our recipe, we can't just add more eggs. We have to add everything in proportion, or we're going to end up with something really gross. When do we use each of these financial statements? We can compare them to rhythm. A monthly rhythm might be to have a monthly board meeting and have the co-op's accountant present a monthly profit and loss. A yearly rhythm would be like ending the fiscal year with a member meeting where everyone sees all three statements. That way the whole membership can help define the pace for the next year. Another good metaphor is a target. The planters have reviewed their assets, decided how much they can afford, and checked to make sure they could make loan payments on time. But day by day, what is each member's goal? When they show up at work, what targets are they trying to hit? You'll often hear these goals called key performance indicators, or KPIs. For the planters, they have a pretty straightforward goal of increasing their revenue enough to balance the cost of their new vehicles. They might also use this as an opportunity to shift their business strategy. If they know they can make more per hour on larger projects, for example, maybe businesses with large campuses or residences with large properties, then they could make the most of their new investment. So they might set a goal to increase that big project revenue by 30%. Naturally, they'd also be able to serve smaller customers better as well. So they might set a goal to increase the smaller customer revenue by 15%.
Monthly, they'll need to be watching their financial statements for some key performance indicators, which will help them make any essential pivots or shifts in their operation so that they can sustain their business. They will want to make sure that those numbers that they projected out, 30% for larger projects and 15% for smaller projects, are actually showing up in their month-to-month revenue.
If the members wanted to stay on track, would something like a monthly huddle help? Or maybe even a time once a week for the team to get together around the relevant parts of their financial statements and look at their revenue, their expenses, and any upcoming challenges. Most businesses that open up their books that way and help every team member understand KPIs find that it makes a big difference to the team's motivation, their job satisfaction, and their productivity. We've talked a lot about how these new auto loans are putting some financial strain on the planters. If the co-op hadn't borrowed money before and doesn't have any values-aligned lenders in their area, like a credit union, for example, they might get stuck with a really high interest rate that changes all of the projections we've shown you so far.
They might do some sort of crowdfunding campaign, do fundraising from their community, which it seems like has been supportive in the past. they might also choose to increase their own member equity in the co-op and each contribute, say, one or 2,000 more dollars on top of their initial buy-in.
We won't go into detail about all of the other ways they could raise money to purchase the trucks, but let's talk about some of them. What if the members pitched in? Member loans are a unique way that co-ops can raise funds. Or instead of loans, like Alex said, they could keep their invested money in the cooperative. What if the co-op sold some stock? Outside investors could buy a stake in the business's profits, usually called preferred stock, because those investors are compensated before member owners if the business dissolves. Co-ops usually do not give outside investors a vote in key decisions, however. Often, co-ops cap the potential returns on the preferred shares, and that may deter some investors. But if the co-op wants to go even further and set up a really sustainable long-term relationship with their investors, it can create a special membership class for them. And finally, if they find a grant opportunity, could the co-op apply for it? Sometimes they can, but at other times they may need to work with a nonprofit that can secure and pass along the grant funds. Remember that cooperatives can have a lot of social, economic, and environmental benefits for their communities, so they can be an ideal target for grant money. Some co-ops even start their own nonprofit for this very reason. At the start of this video, if you were feeling anxious about pro forma and equity and debt, how are you feeling now? Is there something you'd like to learn more about? First, let's recap some of the highlights from this lesson. We learned how to use 3 financial statements. We zeroed in on a key performance indicator for the planters. We learned how equity is essential to a co-op and a little different than you might be used to in conventional businesses. And we talked through the risks, rewards, and responsibilities for co-op members and co-op boards. The reality is that learning these skills means using them. And you may be surprised where active members of a co-op can end up after they start learning these things. Just ask Tama.
When I became a member owner of the New Orleans Food Co-op, where I served on the board. And our co-op really, really needed someone who understood finances. And so they elected me to be on the board. I became treasurer and soon president. And so I really got into the back ends of cooperatives and being a member owner of the food co-op and also seeing it as a viable option to help develop communities and helping to support people meet their needs. So it's been really an exciting journey being in the cooperative sector.
Some folks watching this video might want to go even further. You might be interested to learn that as a job, and being an accountant isn't just about compliance or filing paperwork with the IRS. It can actually be pretty rewarding.
What I really appreciate most is when I'm able to support a cooperative and understanding how their finances actually support them in making critical decisions like determining the price of a menu item. In an example, I've worked with a cooperative that's a restaurant, and understanding food costs was something that they knew about, they knew of the concept, but putting it to paper and actualizing the cost of a recipe to generate one menu item was really fulfilling to see them navigate the process of determining how much they want to sell that product for, and also getting a good value to their customers and generating the kind of profits they need for their operations. So seeing them see the numbers make sense for how they make decisions really is, I think, an important part of what I do.
So, financial literacy can be a really scary concept for a lot of folks who are new, not just to co ops, but maybe to business in general. Do you have any tips for folks who are just starting their cooperative journey and how they can feel more comfortable reading financial statements?
I think having patience and a willingness to learn something new is a really good characteristics of a person who wants to dive deeper into finances, and also having a general curiosity of what drives things. Having that general curiosity helps you dig deeper into like the nuts and bolts kind of thing. And I feel firmly that co-op members should be involved in understanding all of their financials. And I think a lot of members tend to think that there's a group that is handling it, that they don't have to know or be as connected to it. But if they are connected to what really drives profitability and how what they do impacts the cooperative, makes a big difference. And in my opinion, all of the financial statements tell that story. I'm also a member of an accounting and bookkeeping cooperative called Resolve Financial Cooperative, and we support people in learning how to understand and review their finances, and also do trainings to help them, co-op members, understand how to read the financial statements and even do their own bookkeeping if they so choose.
There are a lot of practical ways to get comfortable with business finances, even if you're not considering a career in bookkeeping or accounting. For example, you can find and flip through annual reports yourself on a local co-op's website. Or you might want a summary of how profits flow through a cooperative using the University of Wisconsin's diagram. You can learn about other financial tools like worker-owner sources tables, capital equipment lists, or even break-even analysis. You can even gather your team together and work through exercises like those found inside the USDA's workbooks. And if you're still hungry for more, Cooperation Works offers a 3-part training called The Art and Science of Co-op Development. It's geared towards people who want to provide meaningful professional assistance to groups starting co-ops. We are grateful to Tamar Yisrael for her guidance in the making of this video, and we also want to thank the funders who made this whole video series possible. That's the CHS Foundation, Developing Future Ag Leaders, and the Cooperative Development Foundation.